So at this stage of the Trump rally, the thinking right now is that the only thing that might be able to derail this thing is a bad move from the Federal Reserve. Now, remember last December, Yellen and company, they hiked rates, and as a consequence, 2016 stumbled out of the gate so bad we had some record-breaking sell-off numbers. Now, conventional wisdom holds that the Fed's going to probably hike rates again in December. So what will the markets do? And some people are wondering, is it even unfair to hike now when many believe the Fed didn't pull the trigger before to shield President Obama and Clinton before the election? This week, by the way, there's a parade of Fed talking heads, and their mission, I think, is to get investors ready. Telegraphing the move is smart, but is making the move now, is it going to be based on economic data, and are the trends, most important, are they in place? Now, we've seen consumer confidence soar. We've seen retail sales get stronger. We know wages are turning higher. I think Wall Street could be okay and actually applaud a rate hike if these trends continue. But let's ask two of the very best, Danielle DeMartino Booth and John Hilsenrath. John, you know, Wall Street always grappling with the Fed when it comes to these rate hikes. But, you know, you look at retail sales, you look at consumer confidence, you look at wages. It's hard not to believe that they won't hike rates in December. But what about beyond December?
Well, they've telegraphed that they expect to do another 2 next year. I think a lot is going to depend on what kind of fiscal stimulus program the President-elect Trump comes through with. There's a chance that if he puts through aggressive tax cuts and an infrastructure spending plan and the economy really starts growing faster, the Fed might end up hiking rates a little bit more than it planned because it doesn't want the economy to overheat. Of
course, Danielle, last time they suggested that there would be 4 rate hikes. Wall Street was never comfortable with that. The numbers never, ever suggested that that would be a smart idea. We came out the gate pretty tough. The stock market took a hell of a hit. So they would have to be careful. Even if we say this is a $1 trillion 10-year stimulus plan, they would have to be very, very careful, I think, not to spook the market.
You know, they will, Charles, and they're going to have to acknowledge the things that are going on overseas right now with the extremely violent move upwards that we've seen in rates. We've effectively seen tightening already occur ahead of December's Fed meeting, and you have to be aware of the damage that's being incurred in a lot of these emerging markets economies that in recent years have priced quite a bit of bonds in dollars.
Well, let me shift it to the political angle, guys. Danielle, do you think the Fed could be swayed by politics? You know, Donald Trump was somewhat of a critic of Janet Yellen. She appeared in that last 2-minute commercial when he made his last pitch, if you will, to the American public.
Well, I think politics certainly has played an increasing role, whether or not there's a recognition of this at the Fed or not. But one of the most interesting articles that came out today was an interview with Daniel Tarullo, who has been one of the more dovish members. I think he would have actually dissented had the Fed pushed through with a rate hike in September. He said he feels that the groundwork has been laid. If she's got the final doves on board, then I think that she hikes rates in December regardless, because of all of the inflation metrics that you mentioned earlier rearing their ugly head, in addition to the expectations we've seen ramp up just over the past week since the election.
John has been
Charles, I might add one more point to that. The Fed has been telegraphing this December move since before the election, so I think we need to be careful about inferring too many political motivations into what they're doing. I think if there were a Hillary Clinton presidency, the Fed would probably be on the same path. They signaled after their November meeting, for instance, that their October meeting, that they expected to move in December. So I think we've been on this path for a while now.
You know, that's a great point, John. But I will say I think the Main Street knows of the Fed more now than perhaps at any time in history, at least that I know of. And they've become something of public enemy number one. How would that play?
And you know, just
go ahead, Danielle.
Charles, I would just throw in there that we have to be really careful because of how much debt there is in the U.S. economy and how sensitive U.S. households are to rises in interest rates. We've already seen an appreciable rise in mortgage rates, and these are factors I think that the Fed will take into account going into next year.
That's what I was going to ask you too, also, John. Is that, you know, listen, they. You know, can they allow inflation, particularly inflation 101, people to finally have more cash in their pockets exist, maybe a little bit more than they're comfortable with, understanding that the public already has a major resentment against the work they've done?
Well, you know, I don't think they can let inflation get too far. Their objective is 2%. They've been below that objective for more than 4 years. But we're seeing in the bond market what's going to happen if they let inflation run too fast. That we'll have, you know, so they might keep short-term interest rates low, but long-term interest rates will respond to inflation expectations, and the Fed can't ignore that. We're already seeing that with what's happening with mortgage rates and 10-year Treasury yields. Yeah. And it's why the Fed thinks in the long run they've got to keep inflation around 2%. If they don't, then the cost of financing government debt is going to get very expensive.
And there's going to be a lot more of that, too, no matter what. Guys,
that's the genie in the bottle. That's
thank you
the big
both.
Genie in the bottle they don't want to release. Thank you.
Thank you both very much. Appreciate it.
Thank you.